Most people assume wealth grows in a straight line. Work harder, earn more, save a little, and eventually financial security arrives naturally. But real financial systems do not behave linearly. Wealth compounds unevenly, and because of that, the journey toward financial independence feels psychologically distorted for most people. The strange part is that the first phase often feels almost pointless. Someone earning average income and investing consistently for years may still feel financially stuck. Their account balance grows slowly. Investment returns appear small. Daily life continues consuming most of their attention. The gap between effort and visible progress feels frustratingly large. This is why many people abandon long-term investing before the mathematics ever begin working in their favor. But hidden underneath this slow beginning is a threshold effect that changes everything. And for many investors, that threshold begins around $100,000. Not because the number itself is magical, but because compounding finally becomes visible enough to alter behavior, psychology, and eventually economic reality itself. At low portfolio levels, contributions dominate growth. Someone investing $500 or $1,000 monthly sees progress primarily through deposits. The market may rise or fall, but the portfolio remains too small for investment growth alone to create meaningful acceleration. Financial progress feels dependent entirely on labor income and disciplined saving. This creates a dangerous psychological illusion. People begin believing that wealth accumulation is only about sacrifice. Every dollar invested feels like a dollar removed from present life. The emotional cost feels immediate while the future reward feels abstract and distant. Modern consumer systems intensify this tension constantly. Spending produces visible emotional stimulation immediately. Investing often produces silence. But compounding systems behave differently once scale increases. This equation appears simple, but inside it exists one of the most powerful forces in economics. The critical detail is that growth eventually begins building on previous growth rather than relying entirely on new contributions. At first, this effect is barely noticeable. Then slowly, almost invisibly, the balance becomes large enough for investment returns themselves to start generating meaningful momentum. This is why many long-term investors describe the first $100,000 as psychologically harder than later stages. The early years demand consistency without visible reinforcement. The investor works, saves, contributes, and waits while progress appears modest compared to the effort required. Then eventually something changes. A strong market year suddenly adds more wealth than annual contributions alone. A portfolio moves upward by thousands or tens of thousands of dollars through market growth itself. The investor begins realizing that accumulated capital has started participating in the process independently. This moment changes behavior because it changes identity. Before the threshold, money feels manually produced through labor. After the threshold, money begins feeling partially system-generated through ownership. That psychological shift matters enormously. Throughout history, wealthy individuals understood this distinction intuitively. Merchant families reinvested profits continuously because productive assets generated additional production. Industrial fortunes expanded because ownership systems compounded faster than wages. Modern investing simply democratized access to the same mechanism through stocks, index funds, businesses, and diversified assets. The principle remained unchanged across centuries. Ownership compounds differently from labor. Most people spend decades trapped entirely inside labor-based financial systems. Income enters monthly, expenses remove most of it, and little capital remains productive long enough to generate meaningful acceleration. The person may work extremely hard while remaining economically fragile because labor income alone scales slowly compared to compounded ownership. This is why the first major portfolio milestone feels transformative psychologically even when it does not immediately change external lifestyle. The investor begins seeing evidence that time itself can become economically productive. And once this realization becomes emotionally real, behavior often changes permanently. Consumption decisions start feeling different. Recurring expenses become easier to evaluate long-term. Delayed gratification no longer feels entirely theoretical because the investor has finally witnessed compounding producing measurable outcomes. This is one reason financially resilient individuals often appear calmer about short-term economic noise. They understand that long-duration systems absorb volatility differently than people living entirely paycheck to paycheck. A portfolio capable of generating growth independently changes the emotional relationship between work, uncertainty, and time. But this threshold effect also reveals another uncomfortable truth about modern economies. Most systems surrounding consumers are designed specifically to interrupt compounding before it gains momentum. Lifestyle inflation expands alongside income increases. Financing normalizes future obligations. Subscription ecosystems extract recurring cash flow continuously. Consumer culture encourages visible spending because visible spending drives economic activity. Almost nobody receives social validation for quietly accumulating index funds over 20 years. Yet financially, the invisible behavior often matters more. This creates one of the strangest contradictions in modern society. The behaviors most rewarded socially are often different from the behaviors most rewarded mathematically. A person aggressively displaying wealth may remain financially fragile underneath constant consumption pressure. Meanwhile, someone quietly building productive assets may appear ordinary externally while becoming increasingly resilient internally. The divergence stays hidden for years. Then eventually the compounding curve steepens enough that the difference becomes impossible to ignore. Exponential systems always appear unimpressive during their early stages because human intuition evolved around linear expectations. People expect progress to resemble effort proportionally. But compounding produces delayed acceleration. The most powerful growth often occurs after long periods where little appears to happen externally. This misunderstanding shapes much of modern financial frustration. People compare their slow early investing years against dramatic success stories online without realizing that most compounding systems look boring initially. They underestimate the hidden importance of duration because acceleration remains invisible until the asset base reaches meaningful size. And this is exactly why the first $100,000 matters psychologically. Not because financial freedom suddenly arrives. Not because risk disappears. Not because work becomes optional overnight. But because for the first time, the investor experiences concrete evidence that ownership systems can eventually outpace pure labor systems. That realization changes future behavior more than motivation speeches ever could. Once people emotionally understand compounding through lived experience, patience becomes easier. Consistency becomes easier. Long-term thinking becomes less abstract. Financial systems stop feeling random and begin feeling structural. The portfolio transforms from a number into a productive mechanism. And eventually the investor recognizes something even more important. Financial freedom rarely emerges from extraordinary income spikes or dramatic breakthroughs. More often it emerges from ordinary contributions surviving long enough for compounding mathematics to become dominant. The beginning feels slow because the system is still fragile. The middle accelerates because ownership starts reinforcing itself. And later stages often appear almost unfair to people who never experienced the difficult early phase. That is the hidden psychological barrier surrounding the first $100,000. Most people quit before compounding becomes emotionally believable. Those who continue long enough eventually discover that wealth is not only about money itself. It is about crossing the invisible line where time, ownership, and compounding begin quietly working together on your behalf.